and welcome to the Monday Futures Market Outlook for March 18th, 2013. This is Patrick Ceresna. As always, we start off with a chart of the U.S. dollar index futures. We have been looking for the U.S. dollar to find some overhead resistance and eventually at some point do a little bit of a correction before advancing to those kind of levels like the 84 level on the upside, which is quite a realistic upside target. This morning we had some news about the financial bailout in Cyprus, which at this point has drawn some concerns on the euro and subsequently has allowed the U.S. dollar to strengthen over the weekend. But at this juncture, even some short-term push higher will still likely consolidate. If this for whatever reason steamrolled into something larger, we will look for that 84.50 level on the upside where the highs of summer of 2012 occurred. And if we did find our way up to that level, that's where we'd be looking for a major overhead resistance to potentially reject. So at this stage, watch to see if this upside gains some momentum. If it is, there's another dollar and a half on the upside on the dollar. Next, you have a chart of the euro, and the euro has continued to weaken below that 131.50 focal point. It actually is continuously rejected off that level. Obviously, that Cyprus news created new waves of selling. There's certainly now vulnerability of this euro to deteriorate all the way down to the 127 level where the lows of November came in. So we're watching to see whether it does break to a lower low. If we do get that, then look for that selling of at least 100 to 200 pips lower. Next year, I want to take a look at the 30-year Treasury bond, and this is where we've seen, again, another reversal off of a key support line. If Treasury bonds start to rally, that will be a very important warning sign to the markets. Overall, the correction in the Treasury bonds has really been oriented around a rotation, a risk-on, risk-off type rotation out of bonds and into stocks. But if we are seeing topping formations developing in the markets and subsequently a bond rally, that could feed a big sector switch or asset class switch that may trend for a month or more. Next year, I want to take a look at copper futures. And copper just made a substantial breakdown move that is just on the verge of breaking down to new levels. If we see copper deteriorate below this 345 level, then we will have to be targeting those summer lows around that 3.25 level on the downside. This is a big concern as the stock markets tend to use copper as an indication of the global economic health, and the fact that we continue to see copper deteriorating here should not be ignored. Next year, I want to take a look at crude oil, and while crude oil in the last few weeks has certainly tried to rally back some of that sell-off, you can see here that it's already turning off a little bit off that 94 high. If we see a new wave of selling kick in here, we should see a drop in crude that could drop easily down towards $85 on the downside. So we're going to be watching definitely price action below $91, $92 down below would be concerning. Next year, I want to take a look at gold futures, and this is a place that we should be watching very carefully. Naturally, gold as a commodity tends to want to move inversely to the U.S. dollar, so the euro weakness and the U.S. dollar strength is certainly something that naturally would weaken gold, but at the same time, gold is considered a safe haven or a hedge against global economic risk. And so the fact that this Eurozone crisis is occurring has actually allowed gold to hold up while so many other commodities find themselves selling this morning. It will be interesting to see whether or not gold can move on its own here and independently of the other commodities. One way or another, looks like we have some important supports down around that 1550 level. Looks like here that on this chart, that 1570 was where most of these lows came in, but we have been testing down at some of the key lower levels that don't show on the line charts. Ultimately, we're looking to see whether gold can roll up off of here, particularly any strength above 1620 towards 1650 would be the first positive sign. Finally, I want to take a look at the S&P 500, and here we did have that breakout on the upside. We were suggesting that a break could easily make it up to that 1550, 1560 level where the measured moves all finished off. It's convenient that the Cyprus event occurred off of a key overhead level. This is gonna be very significant. We're gonna be watching to see whether or not the selling gains any momentum or traction on the downside. The biggest thing here is that this has not really started anything yet, but it could. One thing that we're going to be watching for is whether or not topping formations really shape up here. So in this scenario, we might, let's say, sell down to the 1530, 1520 level on the downside, have a rally that makes it back up to the previous highs, but starts putting in double tops and other things that are putting in topping formations that could lead to something bigger as we approach April. Nonetheless, we're not necessarily looking for a significant drop yet. That, again, it tends to happen off after a topping formation rather than a straight start like this. But let's really see whether or not this Cyprus event really triggers something that brings fear back into investors' minds. Just to review our key market observations, we had a good risk-reward proposition in the U.S. dollar when it was down along its lows. Ever since it rallied up into these levels, we switched it to an average risk-reward proposition. That doesn't mean we don't believe the U.S. dollar won't go potentially higher still here, but the risk-reward of owning it here is not remotely as good as it was when we were originally calling that U.S. dollar rally. And we certainly would make the risk-reward proposition poor if we approach the 84 level on the upside. Same with commodities. Commodities have already sold quite a bit. We had a risk-reward proposition that was poor on commodities, but because they already sold off, we're now seeing a scenario where they're starting to become a reasonable proposition, particularly in precious metals. At some stage, when they get weak enough, we will switch that to a good risk-reward proposition to accumulate, but that will likely correspond with when the U.S. dollar turns into a poor proposition. As for bonds, we think that we're seeing some bottoms. There's room for bonds to rally during periods when the stock markets can correct, and so we actually think bond upside versus stocks downside is something that we will see at some point over the next 6 to 8 weeks, and so we're shifting our intermarket observations to reflect that. The U.S. stocks and global stocks represent a poor proposition. This is, again, not an indication that we believe at some point here that there has to be like a market crash or something like that. Ultimately, we've had already a very good run that in duration and in magnitude have already reached levels that corresponded with a lot of other rallies in the past. And so at this juncture, this makes it a poor proposition where there's only a marginal upside for being the risk of being caught in a healthy market correction, and so we remain of a poor rating on U.S. stocks and global stocks. That was your Monday Futures Market Outlook. Thank you for joining me.